Hey everybody, welcome back to Milkshakes Markets Madness, where we talk about financial markets based on Brent's dollar milkshake theory. If you're not familiar with that, go learn more on our YouTube channel. But the madness was definitely present in the market this week. Prices were all over the place, partly from a Fed speech and, of course, the employment data that came out today. But we look at things in a broader scope this episode, wouldn't you say, Brent?
Yeah, it's important to, obviously keep an eye on all the economic data that's coming out, especially in today's environment. But it's really important to look at the bigger picture. I think COVID changed a lot of things. And in many ways, the lens that we use to look at markets before COVID is a different lens than we need to use now when we look at markets. And we get into kind of what some of those are and why we think it's important to consider those.
Definitely think you're going to enjoy this conversation, not only because we highlight what has happened this week, but we really do pull back, look at the big picture, some of the things that have been going on well for over a couple years, even a couple decades. Brent shares his thoughts on that, some more philosophy, and we also touch on some of the geopolitical events that are just starting to kick off again in the Middle East. We hope you enjoy this, but deep down inside, we know you will. Hey everybody, welcome back to Milkshakes Markets Madness. Brent Johnson, what a week we just had. It's interesting. Just outside here in my neighborhood, they're doing a fun run this week. I think it's one of the most oxymoronic statements there is.
I was just thinking that.
And at the same time, today we got non-farm payroll report. I think the correlation why I mention that is because at some point I feel like this official government soft data becomes as oxymoronic to the truth as something as like a fun run. What is your take on today's employment data? And then we'll get into everything else that's happened this week.
Well, it's kind of one of those things is that the jobs number was so good it was bad. I mean, you really just can't make this stuff up. I mean, I think a lot of people were expecting a somewhat weak, maybe it would meet, maybe it would slightly exceed, but I think a lot of people were expecting it to kind of even be a miss. And as a result, equities would probably jump higher. Well, I mean, it was a huge beat. I mean, not a little beat. It was like double expectations. And so initially, the dollar jumped, equities sold off, and a lot of people thought, well, here we go. This is the beginning of the end because Powell just indicated we're data dependent. We kind of pushed back on the rate cut. We'll talk about that here in a little bit. And so then this is the first big data point to come out post the Fed meeting. But by mid-morning, late morning, things were starting to kind of calm down a little bit. And by the afternoon, everything was ripping higher. And, part of it is when you dig into the jobs report, it's not as great as the headline seems, right? I mean, sure, another huge increase in jobs. But when you look at it, full-time jobs are down and part-time jobs continue to increase. And not only that, but then like native-born Americans, I think, I'm not going to get this exactly. I think over the last 18 months or 24 months, something like that, all of the job gains have gone to foreign-born workers, not Native American, not Native Americans, not as in Native American Indians, but just Native Americans. and so again, I kind of feel like there's a little bit of something for everybody in this jobs report. Like if you're bearish and you think the economy's falling apart, well, that's what you say. Yeah, sure, there was a big jobs number, but it's all part-time jobs. It's all services job. There's no real good paying long-term jobs being created. Whereas if you're bullish, you're like, you know what? We've got a Fed who has stopped raising rates. The economy's humming along. Companies are making money. Unemployment's low, and the Fed's going to start cutting rates. That's a great environment to be long equities. And so, to a certain extent, it's kind of like one of those things that you kind of see what you're looking for. But in the meantime, equities just keep going higher. Now, I think it's a little different when you look at bonds, when you look at currencies, when you look at precious metals. But I mean, so far, the name of the game is U.S. equities, and it's kind of fascinating to watch.
Like I was saying, the soft data, or where they're doing these various surveys, they just come into question in terms of it's a lot of what's the headline number? Like you're talking about it beat expectations by 2x. But once you start to look underneath it a little bit more, you have a lot more of this part-time work and the native-born American data you're talking about. I think it goes far back as 2018. since the last time we've actually had gains. I mean, it's been up, it's been down, so it's basically been flat for a long period of time. That is kind of why I bring up the idea of making the comparison or calling it somewhat oxymoronic, because we are an election cycle year. So there's been that narrative that they're going to be any kind of negative economic data. And so when you're looking at these types of reports, certainly one like this is such a blockbuster number, you kind of just laugh it off. At what point do we stop paying attention to things that, aren't really legitimate data sets? No, to your point, you've got to trade the data. So we can look underneath and question that information, but the markets are rallying off of the headline number.
Well, I think that's a great point. And this is something that I will often debate with my friends who are much smarter than I am. And, they'll dig into all these numbers and they figure out how to calculate it, and they calculate it themselves. And they'll say, well, yeah, the official number says this, but it should really be this. And I'm like, hey, that's fine. Maybe you're right, but that's not what the market trades off of. Now, ultimately, in the long term, yeah, perhaps that's, when fundamentals finally matter in the long term, but in the short term, the narrative matters. Right. And so, it kind of depends on if you're an individual investor and you don't have to mark your book to market, and you can live through a 6-month drawdown or a 2-year drawdown or whatever it is, and you don't have to compare yourself to somebody else, then that's fine. But if you are most market participants, most of the participants who drive markets either up or down have to benchmark themselves either to some kind of a benchmark or to their competitors. They have to mark their books once a month, once a quarter, once a year. And so, they are in many ways headline driven. And this is why oftentimes, if you are a contrarian trader, you spend a lot of time being miserable. And then you spend either a couple months or a year being fantastically happy while everybody else is miserable. And then you go back to being miserable again while everybody else is happy, because, markets tend to trend based on headlines, right? And then finally, there's a come to Jesus moment. The contrarian makes a bunch of money. The trend followers or the surfers, they get wiped out by the rogue wave. But then the sun comes out the next morning, everybody starts going surfing again. That's the reality of it. And so, to me, it's just this is part of the reason why I love markets. They're just endlessly fascinating, maddening, fun, scary. It's all of it. It's I think I've told you this before. Like, one of my I'm a basketball player, but one of my favorite speeches, and I'm not alone in this, but there's a guy named Jim Valvano who died of cancer, I think 25 years ago or something like that, and he gave this famous speech at the ESPYs. And I think the biggest message that comes away from that speech was that, don't give up, don't ever give up. But the other part that he said in there, he said, if you have a day where you laugh, where you think and you cry, that's a full day. And I often think of that when I'm looking at the markets, especially now, because, like we've talked, they're maddening. And like, there's sometimes where I laugh. You just cannot believe some of the stuff that's happening. I spend, I don't know how many hours a day just sitting here thinking about things. And then, every now and then something goes against you and you just want to cry. Right. So, it's a full, like being in this job, it's a full experience. You go through all the range of emotions, and it's really amazing. What's probably more amazing than that itself is how quickly your day can go from being bad to good, or good to bad, or vice versa, or back and forth 4 times in the same day. So you really have to kind of train yourself to kind of suppress those emotions that can take you higher or lower. Anyway, that's kind of a tangent I got off on, but it's what makes markets interesting.
I think what's interesting is how frequently you use ocean analogies, considering your somewhat broad phobia of things that live in the ocean. And the other thing is some would certainly categorize you as contrarian. Yet I have to say, given how frequently I interact with you, you're not much of a miserable person. So, the contrarian argument would be one that you highlighted last week, which is like, if there is actually a collapse going on in the U.S., if the U.S. is in risk of losing its status as a global reserve currency, then who's going to come in and replace it? And the argument frequently is China, and China's just kind of falling apart at the moment. And then here today we have a moment like we did with the non-farm payroll. One of the things I'll be interested to get your view on is whether or not you think rate hikes are now back on the table. But as a result of this data point, before we get into the Magnificent Seven and what equities did, bonds got crushed, which means lower prices in bonds, interest rates higher. Maybe the market is now kind of pondering a potential rate hike. Either way, it means higher rates means stronger dollar, and currencies got crushed. So everyone who's constantly saying that the world's about to end, at least for the US dollar, I guess would kind of make you a contrarian. But because the dollar's still here, is that why you're such a happy guy?
Well, I think I just make myself be a happy guy. Like it's it's despite all the problems, it's still a beautiful world, right? And so, but part of the reason is you can't be a contrarian just to be a contrarian. You actually have to have a good reason to be one. So and if you are always a contrarian, you're going to lose money most of the time. And so when you're right, you better make a heck of a lot of money to make up for the long periods of time where you're wrong. And so what I decided a long time ago is that I am going to be, for the most part, a trend follower, and that is markets or assets trend up and to the right. But I am also going to be on the lookout for times that I can either press that bet up and to the right, or when I need to be looking out for that rogue wave, right? And so I'm perfectly happy to be a massive contrarian with a portion of my portfolio, but I'm not. I see no reason to go all in on anything. Like theoretically, I respect the idea. If somebody wants to put all of their chips on the table based on some idea that they have super conviction against, hey man, that's cool. But if you're trying to protect other people's portfolios, that's probably not the best way to do it. And so, you know, my contrarianness, I tend to play with a smaller percent of the portfolio, but I'll try to do it in an asymmetric way that small percent of the portfolio, if I lose it, it doesn't kill me. But if I get it right, you can make a lot of money, and it can actually, help the overall portfolio. But this idea that I think sometimes when people, I think it's fair to say I'm a contrarian. But I think if people saw my portfolio, they wouldn't necessarily say, "Wow, that's a contrarian's portfolio." My opinions are quite contrarian, I think, rather often. But I think it's more important to understand that contrarians usually get beat, right? And so if you are going to be a contrarian, you either better have very good risk management skills, or be right, one of the two. Because if you're a contrarian, the smartest people in the world get it wrong sometimes. Druckenmiller is the greatest ever, and Soros is right up there with him, and Jim Rohn, all these guys, right? They have all gotten, Paul Tudor Jones, these guys have all lost billions of dollars before. So nobody always gets it right. And I think we've talked about this before. When I was young, I probably heard that but didn't believe it. But as I get older, it just makes a lot more sense. And so I don't mind being wrong, because I know it's just part of the game.
Yeah, look, some of these names that you just threw out, I don't get the sense as much, at least from my understanding of their history and how they trade. I don't think they beat the table to death on a contrarian view and sink with the ship, right? So they
No,
may have
they change on a dime.
Correct, and so they're not in love with ideologies and narratives. So I think being contrarian at a certain time would apply to them, but they're not contrarian for contrarian's sake. And certainly, I think the way that you thought even your dollar milkshake theory would play out, I think one of the reasons people think that you just can't let it go is that it's just taking longer than you expected. But you're riding this wave up. But one of the things that's giving you some sleepless nights with this ride up is that so much of it is concentrated in just 7 stocks. I think you shared a chart with me, or perhaps a tweet that was talking about how the Nifty 50 are dead. Do you want to comment on your thoughts on this concentration and how it's a bit of a concern?
Yeah. So in last week's episode, I referenced my friend Todd, who I talk to every week, and he's the best money manager I know, in that he almost always makes money. He very rarely loses money, and he's just very consistent. And so we talked again today, and last week he had asked me, what would I need to get conviction on stuff, and why was I still so skeptical, despite everything going pretty well. And he writes a note too that he sends out, and he sent this note out during the week, and I read it, and he basically highlighted there's equities are doing well, and we've got a Fed that is probably going to ease monetary policy. They've stopped raising. They're probably going to cut. And he said the risks to this are inflation doesn't fall at the rate that it's currently falling, or some unknown rogue wave comes out, and whether it's a commercial real estate collapse or some kind of a war or some geopolitical event comes out and causes the currently well-trending markets to fall very quickly. And so when I read that, I realized it's not so. Combining that with the fact that I've said since last November, I thought directionally, based on what the Fed was doing, that the markets were directionally correct. I just thought from a magnitude perspective, it had gotten way ahead of itself. And so with that in mind, and then reading his note, and it kind of helped crystallize to it. And then also make sure I don't forget about this, the way Powell spoke on Wednesday, because I think that's very important. It made me realize that it's not that I think things are horrible right now. I actually admit that they're going pretty well. I think Powell has, for the most part, done a pretty good job. It's just that these tail events that he's talking about, whether inflation doesn't come down as fast or some kind of a hidden, booby trap that we're not ready for or not expecting. It's not that I think either one of those tail events is the most likely thing. It's just that I think each of those things is more likely than the market is pricing in. And so while I think the market probably should have been higher since November, I don't think it should be as high as it is. So I said if anything happens that takes away from that perfect pricing of the market, then markets could either just stall or pull back pretty quickly. It wouldn't take a whole lot for markets to pull back 5%. And here's the reason. And so I feel like Powell, and last week we talked about, well, what could cause, some of these things to change? Well, the market was pricing in 7 rate cuts not too long ago. And, we had always said the Fed is not going to cut 7 times if the markets are still going up and to the right. And Powell kind of came out and said something. He didn't say it in that way, but that's kind of the message that he gave on Wednesday. And this is going to get a little nuanced here, so stay with me. I'm going to try to say this in a way that doesn't get too confusing. But part of the reason that has kept me cautious is if these rate cuts get kicked down the road and we don't get as many as the market is pricing in. One of the things that could kick it down the road is the markets hold up and inflation doesn't fall down as quickly, right? And so that's basically what Powell said. Powell came out and said, we still need to see more confirmation on the data. The data is going the right way. We're happy with the progress we've made. We think we've made a lot of progress, and we don't think we're going to have to tighten anymore. But we're not ready to start cutting, and you shouldn't expect it at the March meeting. And that's kind of what he said in November, and it's kind of what he said in December. But in November and December, he was much more certain of himself. And one of the things I've talked about Powell a lot over the last couple of years is he's the most clear-spoken central banker that I can remember in my career. He doesn't use fancy words. He doesn't use a bunch of mumbo-jumbo. He pretty much says it in pretty plain English. So what changed for me this time is he kind of said the same thing. But if you didn't just read the transcript, if you listened to him and you watched him and looked at his body language and the way he was answering questions, he seemed much more sure of himself in November and December than he did at this meeting. And you could see when he and we've talked about how I think that he is very concerned about his legacy. He does not want to cut too much and have inflation reaccelerate. And so when they kept asking him over and over, there's even evidence that maybe you should already start cutting. And you can tell he is very afraid. That's the only word I can use: afraid, scared, concerned, that inflation, while it's going the direction he wants, he wants to make sure it doesn't reaccelerate. And as a result, with unemployment at all-time lows and jobs numbers the way they are and stock markets at all-time highs, if you're concerned about inflation reaccelerating and your legacy, why on earth would you start cutting right away? And this is what we talked about last week, and this is basically what Powell confirmed this week as well. So I feel somewhat justified or vindicated for my view based on Powell's comments, and I think he is. And so here's the thing: is if we get again, we're going to have the most important inflation release in history, right? In 2 weeks or 10 days or whatever it is. And so if that number comes in, let's just say it comes in flat, or God forbid, even 0.1% higher than expected. Well, now how can he cut, right? And so I think that, and there's a lot of stuff that, so if March is off the table, and I would say unless there's a big event to the downside, March is now off the table. He basically said that. So that puts us now into May or June for the first cut. There's a lot that can happen between now and then. And if the market is going higher based on rate cuts, and cuts don't come for another 2 or 3, 4 months, and we start to, get some non-perfect conditions in the market, whether it's energy related or Middle East related or China related, then, you kind of get into a situation where markets could reset pretty quickly. And so this is where I say we may get a bunch of rate cuts this year. But if so, I think they will come in quick succession because the Fed is trying to put out some kind of a fire, not because they're just going to cut into an upward moving market just for the hell of it. So that was kind of a very long-winded answer for where I see things. But I think that's pretty important for what's going on right now.
Yeah, I'm used to your long-winded answers, Brent. I'm just trying to keep up with you and my thoughts as you race through the maze, and I'm like, okay, I got to comment on that. I got to comment on that. And then usually by the time you're done, I forget all the things that you were talking about. Now, look, this is the 4th episode of 2024. The first one, you had joked your Magnificent Seven would be the ridiculous unlikelihood of 7 rate cuts coming. Now we're at a point where we didn't even get a month for that to be completely washed off the table. There's the reminder we give frequently, which has been somewhat part of this conversation, that markets trade on expectations. And so you've been saying the expectation is more or less pricing for perfection. And so it's not going to take a global shutdown pandemic to push markets off their path, because they are priced for perfection. And similar to that, though, we do have, a lot of these narratives or places that people are looking for the correction to happen. So we get it that the real Magnificent Seven, these 7 tech stocks or tech related enterprises, are driving most of the indexes higher. There's other things that, people have been pounding the table on that are going to lead to some sort of crisis, housing market being one, the yield curve, contingent, where people can't get enough of talking about the yield curve. Well, the damn yield curve has been inverted almost as long as it's ever been in history. Oftentimes there's a lag between the yield curve inversion and when a recession hits. And a lot of people like to talk about, the smoke before the fire is when the curve starts to steepen again. Well, today just completely wiped out all of that steepening. So we're still back into this yield curve flattening limbo land. And one of the things, what I'm kind of leading to, I'm curious in the kind of the thought experience that you have with yourself and with your friends, and you're trying to guess where things are going. I believe we just had some military action take place here after the market closed. You can talk about that here in a second, but have you thought about, because it's never where everyone's looking. So everyone's looking at the tech Magnificent Seven. Everyone for a long time is saying housing's overpriced. They got that one wrong. It's never where people are looking. It's where people aren't looking that black swan event occurs. Have you given any thought or speculation as to an area where maybe people are overlooking?
Oh yeah, absolutely. So here's the thing. Everybody's focused on the Magnificent Seven, and for good reason. I mean, so think about this: the S&P was up 1% today, but the Magnificent Seven, like Apple was down initially, but it ended up going up, I don't know, 1 or 2%. Amazon was up 10%. Meta was up 10%. The Nvidia was up, I don't know, 5, 6, 7%, something like that. So you realize the if the S&P was only up 1%, but these Magnificent Seven were up 10, what does that mean all the others did? Right? You would think if when the leaders were up 10% plus, then the S&P is going to be up 2 or 3% just based on those huge gains of the leaders, but it's not. It's up 1%. So that means most of the stocks are not going up that much, or if they are going up, they're going up just a tiny bit. The Russell, I think, that's the small cap stocks. They were down today. So I think people are totally looking in the wrong place, and I am much more concerned with something going wrong outside the United States than I am going wrong inside the United States. And here's the other thing: is even if something does go wrong inside the United States, it has huge ramifications for those outside the United States. And one of the things we saw this week was, Japan. Japan, they had huge exposure to U.S. real estate, and some of the problems in the commercial real estate in the U.S. are leading to problems in a Japanese bank. Well, these Japanese banks are often interconnected, and if they've been talking about raising rates over there, well, how can they raise rates over there? If their banks are in trouble because of their commercial real estate exposure. And, Japan doesn't just have exposure to the United States; they have huge exposure to China. And China's got huge problems in the real estate market. So I am just as concerned, if not more concerned, with problems outside the United States. The other reason that we kind of talked about, not believing in these Magnificent Seven rate cuts and not being a full believer in this move in the equity market is, again, not so much what happens in the U.S., but is the Fed really going to cut more than the ECB is? I mean, again, look at the United States. Does the United States have problems? Of course it does. But, its GDP is growing, stock market's high, unemployment's low, But in Germany, everything continues to fall. Their industrial capacity continues to fall. They're not in recession territory, but they're heading there. Do we really think that the Fed is going to cut dramatically more than the ECB? And now with, even Lagarde last week said we're probably going to have to cut rates later in the spring or summer. And many people thought, well, that's going to be after the Fed. Well, now with the Fed maybe not cutting till the spring or the summer, maybe the ECB has to cut before the Fed, right? And I mean, that changes a whole lot of things if the ECB starts cutting before the Fed. So, it's, again, I can come up with a handful of reasons why things are pretty good and why markets should continue higher. It's just that I can come up with a lot more reasons to be cautious. And so when my process and when my indicators tell me to be cautious, I'm cautious. And the thing is, I don't like being cautious, but you got to take the emotion out of it. And when your indicators are telling you to be cautious, you just kind of got to trust them. Either that, or you got to come up with a new system.
Did have some sort of drone attack on a U.S. base in Jordan recently. A lot of speculation that was somehow related to Iran, or Iran indirectly funded it, something along those lines. A lot of war hawking going on around that event. Just recently, I guess there was some escalation in Syria. What is your take on some of the geopolitics and some of the war escalations and how this could affect? Are we going to just be in our own little bubble and Magnificent Seven is going to keep going up because everybody needs chips from Nvidia, or is this kind of the swan that just hasn't turned black yet?
Well, it wouldn't be a black swan because, I mean, the Middle East would be the widest of swans. I mean, people have looked at the Middle East as a potential, problem for literally decades, if not millennia, right? And so, but just because it's a white swan doesn't mean you can ignore it, right? I mean, here's the thing. So I already saw some headlines. So the U.S. started some retaliatory strikes in eastern Syria today, and so I've already seen the headlines. U.S. is Syria is a sovereign country, and they were not invited. The U.S. was not invited in. They're in violation of international law, all this stuff. And here's the thing. And I always pause when I start talking about this stuff because people hate it when I say this. But the U.S. doesn't care. Now, maybe they should care, but they don't. I mean, they are the global head. It's like telling the bully on the playground that punching people is not nice. You're right. It's not nice, but he's not going to stop. And so, again, if I'm, looking at what's going to happen in the world, international law doesn't mean a whole lot to me, to be honest, because at that level, the laws don't really matter because, might makes right, and they'll just rewrite the laws or rewrite the rules. And, I saw somebody this week, who was, I think it was a former ambassador to China or something. I think it was either a UK or an Australian ambassador to China and the UN. So he's, very steeped in global politics and geopolitics and negotiations and stuff like that. And he basically said the geopolitical order, there's a fancy word for it that basically means the normal way of doing things or the right way of doing things is basically whatever the United States says it is. And they keep rewriting the rules every couple of years in their favor. And my response to that is, he's right. I mean, that is right. I mean, the big guy on the block writes the rules, and when it favors him, he keeps the rules, and when it doesn't favor him, he changes the rules. And so, I kind of feel like we're in this period of time where, the U.S. is trying to exert its influence as the hegemon, and we've got all these challengers, and people are rightfully, in many ways, tired of the U.S. being the global bully. And the U.S. is like, well, I can understand that you're tired of it, but that doesn't mean I'm going to change my ways. And so I think we're going to continue to have these conflicts, right? And whether they happen in the South China Sea or whether it happens in the Middle East or whether it happens in South America or North America, it's, it'll happen on the streets of Chicago. We've got this. I hate to keep referencing the fourth turning because I feel like it's kind of become a cliche, but we're in a period of time where all institutions are being challenged, right? In many ways the people are no longer happy with the powers that be, and they're pushing back. And you can look at that on a city level or a country level or a geopolitical level, and I think that's what we see playing out here. So I unfortunately expect these military confrontations to intensify and multiply. And my God, I would love to be wrong on this. I would absolutely love to be wrong. So if anybody wants to tell me I'm wrong and tell me why I'm wrong, I will happily listen, and I will pray that you are right.
Well, having done this show with you now, we're in our second full season. We kind of did a little teaser, season 0, back in the end of 2022. One of the things that we talked about in the beginning of last year was a phrase that you coined, violently sideways. That episode came out in February 18 of 2023. So we're almost a year into that being kind of a theme, and we're still looking at something very, very similar. Now, when you talk about some of the geopolitical stuff you just mentioned, one of the things too, having been part of this show for so long, is I'm able to have a front row seat and probably pay attention to it much more than I would otherwise. The unwillingness for people to actually get the points that you're making or listen beyond what they want to believe. And one of the things that you're frequently saying is exactly what you just said. This isn't about what you think should happen. This is more you focusing on what is the reality. Now, one of my favorite conversations that we've had, and it's part of our Start Here playlist. So if you go to our YouTube channel, you see at the top, we have a playlist to Start Here. It kind of it's Brent's dollar milkshake theory presentation, so you can get the core concept of what the dollar milkshake theory is actually saying, because most people get that wrong because they got some 30-second version of it. Then there's a few other clips that kind of support that. One of my favorites Comes from an episode. I think it's something like Fiat Money Fairy Tales, something along those lines. We have a clip in that playlist that says prisoners of the system. And you go through this whole analogy talking about, the trading of sardines in prison. And it's not a matter of whether or not you think money should be gold or that money should be whatever your version is, BRICS currency. If you're in that system and there's a bully that's running that system, you play by those rules. And you might not like it, but when you're in those prison walls, it's feast or famine. You have to survive under that system or you get taken out. And I think that analogy is so profound because people want to kind of pretend that they live in a utopian world where rules matter. And as much as that fairy tale helps us get through the day, we kind of very much are living in prison walls.
Yeah, I mean, again, whether you view them as walls for your incarceration or walls for your own safety, that's open to interpretation, but the walls are there and the prison wardens are there and they got guns. I hate to tell you, they got guns. But along these lines, there's a guy named Michael Every. I hope I'm saying that name right. I think I am. He works for Rabobank, a big European bank, and he said something. I listened to an interview of his maybe 6 months ago, 9 months ago, and I think he just absolutely nailed it. He said something to the effect, and I hope I get this right, so I'm paraphrasing, but he basically said, up until COVID, everything was about who could make the cheapest widget in the most efficient form possible, and profit was all that mattered. And after COVID, that is no longer the most important thing, and as a result, everything changes. And when he said that, I was like, that is I wish I had said that because that's right. Again, for 30 years, we were in a world that was globalizing and cooperating and working together and becoming more efficient and becoming more together. And now we are in a world which is not as efficient. It's fracturing. There's not as much cooperation. And profit and who makes the cheapest widget is no longer the most important thing, because now you got to worry about things like national security and supply chains and, social issues. And sometimes, by who provides the cheapest solution isn't necessarily the safest solution. Maybe it's not in the best interest of national security. And that changes everything. It really does, and it's really profound. And again, this is kind of a fourth turning thing. It's like we are in this period that many things are going to change, and I think that process of change, while on the one hand is going to be fascinating, on the other hand it's going to be scary as well. And I think trying to navigate all that while it's kind of like the Super Bowl for somebody like me. It's not necessarily, you've also got Ray Lewis running at you, and Ray Lewis weighs 250 pounds and is 6'7", and he runs a 4.040, right? And Jesus, if he hits you, it's going to hurt. And so I don't know how I got on that tangent, but but to your point, again, just because something should work a certain way doesn't mean it's going to. Just because something should happen from a moral perspective doesn't mean it's going to. So I think you really got to figure out, with regard to your portfolio, are you trying to change the world, or are you trying to change the size of your portfolio? And if you're trying to make the size of your portfolio bigger, you have to face some hard truths. And, I think that's one of the things that we try to do here. I know a lot of the times what we just get together and talk, and a lot of the stuff is repetitive, but, I do hope for, we know from the comments that a lot of people just don't get it, or at least don't get what we're trying to say. But I will say we do also find out from the comments that people do get it. And if we get 2 out of 100, we'll keep doing it. So I hope those of you who find it helpful continue to tune in and continue to find it helpful. Because the reality is, John and we're trying to figure it out too. I certainly don't have all the answers. John doesn't have all the answers. I keep referencing these great, legendary investors. Druckenmiller doesn't have all the answers. He's got more answers than probably anybody else, but he doesn't have all of them. And so, keep this in mind when you find your latest guru on YouTube, or you go to a conference and you really like what somebody says, is, definitely listen to them. But just because somebody says something doesn't mean it's 100% correct. And that applies to me as well. Do your own. When I say something, go do your own homework and test it and see whether you think I'm right. And I am in many ways just trying to figure this out. And I've been kind of studying this for 15, 16 years now. And what I'm trying to do is share what I learn. And I feel like I've learned a lot. And so if I can, pass some of that on, that's kind of my way of giving back, I guess.
You're so altruistic.
Well, no, you know what? Here's the thing, though. Here's the thing. This actually came up. When did this come up? This came up. Where was I at? I was basically okay. So I don't remember where I was at, but they said, "Well, what do you like about your job? What's your job?" And I basically told them. They're like, "Is it fulfilling?" And I had to sit back, and it's like, it's fulfilling for me, but am I changing the world? Probably not. I'm keeping very wealthy people wealthy. There's not a lot of fulfillment in that, other than doing a job well. But I do kind of feel like this is a way to kind of help those people who I'm not helping directly, and maybe navigate this a little bit better. So, I'm certainly not the most altruistic person in the world, but I do deep down want to help people.
Well, we're going to keep working on helping more people as best we can, not just with the entertainment that goes on the show, but we have some fun business ideas and other ways that I think everyone can participate and benefit with us and with Brent's investment strategies. But one of the things that's I do want to highlight here is, you share this quote from this other banker, but I think what was more profound was the quote that you made, which is, I think, really summing up not only this conversation, but a lot of the conversations we have, which is, do you want to change the size of your portfolio, or do you want to change the world? And I think people need to really think about that question, because they're both, things that you can pursue, but you got to pick one when it comes down to, succeeding in one or the other. And, it's funny because you made the comment multiple times a moment ago, at the same time when you're sharing your views on that gentleman's quote, and that, this changes everything. And I don't know, are you familiar? There's a little squeeze bottle, drink flavoring called Mio. Are you familiar with this?
I actually do know what you're talking about. I don't know why I know, but I do know what you're talking about.
They have one of the funniest commercials that it's just burned in my brain, where the whole thing is Mio, it changes everything. And the commercial is they're squirting it underwater, and the guy turns into this little midget cowboy, and then there's a woman who becomes a ninja.
Really changes your water.
It changes everything.
So dollar milkshake theory, squirt that into your portfolio. It'll change everything. Hopefully watching this show and participating in our conversations helps you change the size of your portfolio. And if you got some spare time outside of that, go ahead and change the world. Hopefully you didn't change the channel and you stuck with us.
It's amazing to me that people tune in for this.
Well, we hope that they continue to do so. And if you want to leave a comment, please go ahead to the Milkshakes Pod YouTube channel using the handle Milkshakes Pod. You can also find us on Twitter using that same handle. Brent is at Santiago AU Fund. I'm at John Kutsmeda. We appreciate everybody joining us here. We'll see you guys all real soon. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.